Hello everyone, Mark here at Tesla, and today was a green day for Tesla, slightly green that is. It closed at $267.43, which was a 99-cent increase over the open, translating to 0.37% of a increase over last week. So the market was just not very exciting today. So before we dive into the charts to see that very unexciting price action, we'll get to some really quick news. There wasn't really much going on for Tesla or the market really overall today. But we'll take a look at some interesting tidbits here, with the first being Tesla and other automakers are being solicited by Exxon to perhaps get some deals and contracts going for their Arkansas lithium, I want to say mines, but really is they're actually just pumping like a brine out of the ground. And which is kind of interesting because that works perfectly for the likes of Exxon, who's very good at drilling. So the article from Electrek goes on to say, Tesla and other automakers are reportedly in talks with Exxon Mobil to secure lithium from a new source in Arkansas. There are a few metals that need to be mined to support the increased demand for batteries, which is primarily driven by the rise of electric vehicles. Lithium is one of the metals at the top of that list. Now, I think we know that lithium is an element in its various types of forms that is widely available all over the world. It's just that in America, we really haven't tapped it as a resource very much. I think that it's going to be a nice concession for the likes of the oil majors, like be it Chevron or Exxon, to get into this business because they're not really getting permits for new oil discoveries. They're not even interested in developing any resources they haven't developed yet. The Permian Basin maybe is tapped out, and the reality is this administration doesn't really want more oil to be produced. So they understand the environment, and Exxon is trying to get in front of this by being a source of lithium to the world that's becoming electrified. So it kind of makes sense. Now, we don't know if there's going to be, and I tried looking for it, I'm not sure if the assets they purchased already comes with all the necessary permits to just get started immediately. But there are already smaller companies that are already starting production of these lithium brine deposits. So maybe the rights that Exxon has purchased maybe already has all the permits, and they just want to make sure the demand is there to actually get this part of the business started. Here's another article. Exxon expands lithium plans with a new Arkansas deal. This is an older article that kind of explains back in, June? Yeah, end of June, when they kind of solidified this deal. So if you're interested in trying to kind of ride the wave of an energy rebound, there's two names listed in this article that I actually have traded a lot in the past, in the last year, in 2022. As you know, energy was the trade. Exxon, of course, XOM, and apparently Schlumberger, SLB, which is the ticker. And this is not financial advice. Something you want to look into if you believe, and this is kind of like, and you're hearing this trade a lot. People are saying energy is rebounding. People are also saying that over the past couple of months, you probably notice yourself, if you're driving any type of internal combustion engine vehicle or getting gas for your lawnmower or whatever, you're seeing prices of energy going up. And it's kind of because there is this idea that a China that is going to stimulate its economy, or a China that really just has an economy that's in a rebound, will require a lot of commodities, be it copper, oil, natural gas, what have you. Even maybe some precious minerals as well, gold and silver. So if you believe that we are in a topping pattern in the indexes, meaning that maybe we're a little bit overbought, I don't necessarily agree, but let's say you are, how do you hedge in a regime change from this bull market in tech stocks? What do you do after that? Do you chase energy stocks? Do you chase healthcare stocks? Like what do you do to find some gains and momentum to the upside? Well, if these companies are already perhaps working with companies that require a lot of lithium, be it battery manufacturers or electronic vehicle manufacturers, this could be a potential how do I say this? Almost like a barbell trade where you're already long Tesla, right? If you go long energy stocks that happen to be interested and exploiting lithium resources, that could be okay. You're in the energy play because energy is probably the most depressed sector this year in 2023 when it comes to like looking at the different like sector ETFs, XLE compared to like XLY, XLC. So if you look at XLE, it had a really good day today, yes, but it is very much underperforming the rest of the sectors in the market. Just something to think about if you're looking for some diversification, non-financial advice. Just do your own research. Understand that the exploitation of these resources might take longer than we can even understand. And even if they were to provide lithium to these companies, when are their battery factories going to be up and running? When would the lithium refinery plants be able to accept this? Are there enough refinery plants in America to accept domestic lithium loads of whatever Exxon is able to produce? That's going to be the interesting, and what type of like lithium are they providing as well? That's going to be all really interesting. I hope someone like the Limiting Factor on YouTube makes some videos explaining what Exxon could do and if that's actually reasonable, because there is a lot of lithium in the world. It's just not exploited. So another little bit of information is just a small article here in thestreet.com talking about how Tesla's dominant pushes major car maker to exit electric vehicles. And we all know that you can't just exit electric vehicles. Like if you want to sell cars in China, Europe, or America, and you're in this article, for instance, maybe you're Nissan or Mazda, you're going to need to provide some type of electrified vehicle. Otherwise, you're just not going to be able to sell your cars here. So the article might be a little bit exaggerating, but here in the highlighted section in green, Nissan says that they're going to be ending the Leaf production. In the next few years, they'll replace it with something new, perhaps in 2026. And GM's doing the same thing with the Bolt, and we heard about that last week. And what you can really understand here is that they know that they're not really making money on the way they're manufacturing these vehicles now. They're not Tesla in the way that they are focusing on the efficiency. The factory is the real prize of Tesla. Their ability to do heavy manufacturing in a way that gets them the volume, it gets them the cost savings, and is able to pass it on to the customers. Like I think you probably heard if you're on Twitter, like the pricing for the Blazer EV, the Chevy Blazer EV came out, and I think it's the base model is going to be somewhere in the range of like $45,000 to $52,000, where you can get a Model Y for much less than that. You can get a Model 3 for much less than that, who have better software and with, I would say, better infrastructure to support that vehicle as well. So a lot of these people they're making EVs, but they can't make money. So they have to charge a little bit more, which would then dissuade people from buying the expensive cars. So it's like this downward spiral for them. So Mazda discontinues its MX-30 SUV electrified vehicle in the United States. They'll still sell it in Europe. They'll still try to sell it in Japan. But it kind of says a lot about people understanding that the market that they perceived wasn't a market for EVs. It was a market for Teslas. I mean, the idea of owning a Tesla. I know that there's some real big time haters out there, and there's people that maybe are very, very bullish or maybe too bullish on Tesla. But the reality is, like, if I'm talking to like my family, my extended family, my friends, the idea of an electrified vehicle is always a Tesla. There's always there might be this very fringe talk about, hey, check out this Porsche. It's really, really cool. But come on, like no one's buying the Porsche. No one can afford it. I mean, I think Porsche said it themselves. They're not able to get the volume they want. And the reality is because I don't think they can justify this ramping something up, which they perceive as not having the demand. The last paragraph of this article goes on to say, Mazda will focus its electrification efforts on plug-in hybrid EVs, such as their CX-90 plug-in EV. So this is something that other manufacturers are doing as well. So they know that the Inflation Reduction Act in America, the IRA, is essentially a bailout for car manufacturers. That's essentially what it is, but only if you're providing an electrified vehicle. The thing about it is, we might have thought, or some people might think that, okay, that means I just need to buy a full battery electric vehicle, right? But not necessarily true. Where hybrid EVs or plug-in hybrids, essentially, they can get subsidies from these programs with the IRA, and that's what Ford is doing too, as well. Ford is almost seeding the market, meaning that they understand that they're in a position that is much further behind than they expected, even just 1 or 2 years ago. I mean, didn't they say they'd be outproducing Tesla within 1 to 2 years from now? And I don't think they're going to get close to that, unfortunately. But yeah, even Ford is going along they want to take advantage of these rebates for their customers by providing hybrid EVs. But I mean, at the end of the day, who's going to buy it? I'm really not sure people would find it very interesting. Hybrids, it's almost like they have like twice the number of parts, twice the number of things that can go wrong, substandard warranties for these systems, and they'll be outdated so quickly. I honestly don't even see the point. But enough for the news. Let's go ahead and check out the charts really quick. Sorry for the late video today, but we'll go ahead and look at the charts and see if anything's actually going on. So here's the chart of Tesla. Now, I was taking a look at Tesla today, and I was looking at some other time frames other than the minute, but we were talking about last week, two squiggly lines, about what perhaps could the price action look like and be anticipated, considering the events that are coming this week. We have Amazon and Apple reporting later on in the week. At the end of the week, we have non-farm payrolls, which is the big jobs indicator. We have the private payrolls on Wednesday as well. So it's kind of action-packed along with the other earnings. There's a lot of earnings coming out this week. So just kind of understand that I always say like, oh, there's more volatility, but we haven't seen volatility much at all. But I was looking at the chart and I kind of understood like, okay, if you're familiar with technical analysis, or if you're familiar with like the Wyckoff patterns, Wyckoff is a technician who kind of started seeing these patterns develop in a way after a stock moves, be it up or down in a big way. There's this consolidation period, and he analyzed these consolidation periods. He kind of drew out schematics that shows, okay, look, I'm seeing a reoccurring trend on how pricing works after a move. So essentially what the pattern I'm seeing here that it could possibly pay out is something called an accumulation, meaning that shares are being bought up and supported at a certain level. And I think we knew that level already. We drew this line last week. It was 255, 256. That found a lot of interest. And so every time pricing hits that, it goes up because people are wanting to place orders. Now, the idea of testing a lower zone of your range that we're in, being the 255, the idea is that if you keep testing it over and over again, eventually the people who had interest at 255 and 256, their orders will be exhausted. And if that ever became the case, the pricing would just fall through, right? Because you took out all the orders, so all the liquidity here, basically meaning all the people who have money placed at this point. So basically a lot of people just place orders and they're good till canceled, meaning that they place an order. I want to buy 10 shares of Tesla at 256, and it's whenever it gets there, I don't care what day it is. I don't care if it's a month from now, if it's tomorrow. I want that order filled. And so a lot of people trade in that way because they just want to have like this. They just want to just nibble at their investments. Every maybe a couple of weeks they put in a new order. And so that's what's happening when you see this type of price action. When it goes down to a level, it bounces off. It's because there's orders there, there's interest there, and it tries it again, and it keeps trying it until it realizes one of two things: that there's not enough quote unquote support, and the price just falls through, or that there is so much support that people see the price get to like 255, 256. Their orders not getting filled, so they're chasing the price up because they're like, look. They're understanding there's a lot of interest there. And if there's so much interest and there's not enough selling that they need to get, if they want to get in position now before it's, $275 a share, they're going to kind of chase the price a little bit. And you're noticing that we drew this green box. This green box was at the bottom of the range. A very small consolidation after sell-off over here in July. Early July, looks like July 7th. We had a pretty sharp sell-off, some volatility there. And the pricing kind of rested above this area and then gapped up. Well, we're still in that area. We're chopping around in there a lot. So it's not surprising that we're still there now. Because this is the area that, okay, let's say you're a momentum trader, if you're a trader at all, if you're just a day trader or a swing trader, let's say you do have your orders put at 255, 256. And all of a sudden you see the pricing get to 267.50. Now, first of all, we know 267.50 is a perfect number, okay, for a strike for an option for Tesla, right? It's always these $2.50 increments. So 267.50 kind of makes sense where you're finding some resistance, but also this is the selling resistance for the range for the last, 6-7 days. When it broke through and it kind of settled on it and kind of tried to use that 267 as support, but fell through. You can see it here. It falls through. It gets bought back up a little bit. It hits that same 267. It sells off. It stays on the bottom of our green little box. It gets tried to get bought. It gaps up. So it kind of popped above the resistance, gets sold off, goes back up again, gets sold off big time again, and gets back up, and it just sits there. It peaks up a little bit right here on the open. So it gapped up, sold off immediately to 267.50, sold off even more, peaked above again, sold off, peaked above, sold off. At the end of the day, it gets bought up and sits right underneath it. As you can see, 267.43. So we know this is a very important area. But if you're looking at the options, like we can take a look at the options real quick. And I know there's not going to be a lot of volume for the options because it's just Monday. And then we proved last week, most of the volume comes in on the last day of these options, option chains. So let's go ahead and take a look at the old Max Payne website and see if we can see where calls and puts are accumulating. And you probably saw on the chart, I already put the call wall in a blue line, but we'll look at that again in a second. So here's the open interest. A lot of open interest is currently at 275. That's not too surprising. This could be a lot of leftover interest from even the earnings run up. The puts, so a lot of puts are interested at the 245 strike and the 260 strike. But look at the volume. Let's look at the volume of calls, meaning the ones that are orders being placed. A lot of calls at the 270. That's a lot. And a lot of puts at the 265 and a lot at 260. So we're seeing these two big peaks. This is just these two strikes alone. That's over 100,000 in volume, 72,000 and 54,000 at 275 for the call volume. So we could say the floor is going to be from 260 to 265 currently. And the call wall, meaning the ceiling of pricing, is around 270. So we already seen today that the 265, we kind of just chopped around from 263.80, closing at 267.50 area. So we're in that zone for a kind of a floor for pricing, with 260 maybe being the lowest currently. You might find support at. If we were to fall, and it kind of depends on the context. Like if we fall because of really bad misses on Apple and Amazon dragging the index down, you can see a new low being made. We drew that diagonal line over here anyways for that particular reason, that by the time it gets to the close of Thursday, we're going to be sitting here, if the horizontal support holds, the diagonal line we drew, which is kind of from the gap up and the bottom of the range, we want to stay above this area. Okay. So if you see pricing, if we de-risk as the rest of the week goes on, if we don't, here's the 260, it intersects the Apple's and Amazon earnings day. If we fall below it, it'll be pretty quick to fill the gaps below, probably to 233, something like that. Of course, I don't want that, obviously, but we drew these lines for a reason. We figured that if the action isn't too convincing, that you'd probably see what we saw in orange. And it's following the orange line for now, which is, you're going to see some, you might see a little buying, but the call wall will push you back down and you'd probably chop up and de-risk, meaning that people will sell stocks, because the risk of holding into some of the biggest earnings for the season, Apple and Amazon together, would be maybe not too comforting to hold on to something like Tesla, who's going to move more than the rest of the stocks will in the index. But going back to the pattern of Wyckoff, this is kind of what I'm seeing when it comes to the Wyckoff pattern. It's and if you can look it up yourself if you want to. It's Wyckoff accumulation, and essentially it's just kind of showing a support zone is being created, and it is the liquidity is being basically sopped up, and it's moving up from that point on. And so far, it kind of looks like a typical accumulation pattern. But the reality is, accumulation can always look like the opposite in this kind of schematic, which would be a distribution, meaning shares are being distributed amongst other people, basically slowly being sold essentially, and to the point where they exhaust all the buyers, and then the price falls through, like we talked about, which would look something like boom, like that. It would be quick. It'd be really, really quick. So that could be a distribution pattern would be following. So both patterns can follow this yellow line where it's kind of making a high. And if I was a market maker, I'd probably get people really bulled up by doing that, by moving this price to the 270 area. And if you see the 270 area hit, be it tomorrow, be it Wednesday, and you're seeing sharp sells off, it's because, remember, there's a call wall at 270. They're in the money. They're going to sell their calls. People are going to sell their shares, and they're taking profit essentially. So which a healthy move for either an accumulation or distribution would be a peak over the 270, selling back to 270, and basing here until the earnings on Thursday. And that means there wouldn't be much movement overall for most stocks that are the mega cap stocks. You might find your beta in a different sector altogether outside of technology. And what would those be? Well, the depressed sectors, we're talking energy, we're talking small caps like the Russell 2000, we're talking healthcare, perhaps individually depressed names. Like you saw a really big move in Disney. Target has been suppressed for a very long time because people fear the boycotts, and people fear the inability for them and retailers in general to do something about theft, which they consider a shrinkage. So if it plays out where you see a sharp move up tomorrow or Wednesday and it's a quick pullback, just know that quick pullback was your idea to either do one of two things: take profit on if you have calls for the week, maybe get out of those calls and move them out if you want to stay long, not financial advice, or sell calls against your shares at the 271, 272 area. And we can talk about, we're going to talk about calls at the end of this video real quick, because I don't know if people understand when I'm speaking of like a calendar spread to protect the upside risk. So if you see pricing get to around above this green line, which is the green line is 272, if you see pricing get up there, that's a very solid move where maybe you can take a little of your chips off the table. What would that move look like in percentage terms? And you know that Tesla can move very violently. I mean, a gap up of 1% to 2% is not unheard of. To get above this green line, to show like following this yellow line in this pattern, that would only take about a little over 2% of a move for Tesla. So you have to be really quick. Like, you have to be super quick, because a 2% move can sell off really fast. And if it does sell off really fast, number one, that's going to suck. I don't want that to sell off. But you see it a lot already. And what are some examples of that? I mean, I think the obvious example is the pricing, the price action last Thursday, which was a 5% move from the high of the day. And even today, let's see, if we were to measure from the open to the daily low, that's 2%, 1.98%. So a 2% move can happen really quick in a blink of an eye. But if you, let's say, for example, today, you identify that, okay, we got to 269 and if you're charting, 269 was a previous high, and you can be like, okay, yeah, that makes sense. I can take a little of the cards off the table. chips off the table. I can maybe sell calls. Maybe I can close out my calls if I have bought calls. So that's something you want to look at. From the indicator aspect, on this time frame, the 15-minute, we're looking pretty oversold, but we had a really, really good close. So what that means is RSI was just completely in the middle doing nothing. This just means a couple things. There's no volume. There wasn't a lot of shares being moved around today. People just didn't really have any interest at all. People were thinking that today would have been a lot of action at 2 p.m. Eastern time, which would have been the SLUS Senior Loan Officer Survey, which basically just literally surveys loan officers at brokerages, banks, ask them what the environment is like for loans. Specifically, in this case, the loans of interest were commercial real estate loans and commercial loans in general. They're saying the gist of it is, and it wasn't that big of a deal because obviously at 2 p.m. on their chart, literally nothing happened. So there is definitely a tightening of credit when it comes to commercial real estate loans. I think we all know that. I think pricing has already reflected that in the commercial REITs, be it like a SL Green, for instance, or Vornado. I think that's a VNO ticker, and SLG for SL Green. And you can kind of take a look at those things if you're interested in seeing how the market has already priced in a lot of negativity when it comes to commercial loans. So I don't think the SLUS was going to move. I think the reason the SLUS didn't move the market is because it's everything we knew all that stuff already. We get it. People don't want to issue new commercial loans because half of these people, even BlackRock or Blackstone, they're not paying their bills. You might hear about Elon not paying his rent at the Twitter headquarters in San Francisco. But that's the thing. Why pay for something? And this is no different than tactical bankruptcies in 2008 during the great financial crisis. Why pay? Okay, why pay overpriced rent for property that has depreciated in value dramatically? I mean, for some places in San Francisco, the commercial real estate that people are own or rent have dropped 75% in value. No one is interested in being downtown San Francisco, nor downtown in any major city. So if you are a tenant in one of these really depressed buildings, you have a lot of leverage over your landlord. So people give Elon a bunch of crap saying he's not paying his bills, he's being petty, he's worth billions of dollars, but this is business. Okay? The business is not his personal wealth. The business is, look, he has very limited income for X now, X/Twitter. So why pay when the likes of Blackstone doesn't pay their bills? The SL Green or Vornado or the other REITs don't pay their bills? BlackRock? These people are literally defaulting. And we're probably, I'm interested in seeing how many of Bank of America's commercial loan clients have defaulted on their loans to Bank of America. And that's why Bank of America's price action is so much not in line with the other banks. Has a lot of exposure to commercial real estate. So that's why, if you want to know why people are hammering Elon about not paying his rent, he's not paying his rent because it's not a smart business decision. If the landlord of Twitter's headquarters wants money, redo my contract. Otherwise, I will stay here, and I probably have a lot of California very progressive eviction protections. And you probably see that if you're renting property in California, finding a really good tenant, it could be, if you find a good tenant, that's literally a gold mine because a lot of people don't pay their rent and you can't kick them out. So it didn't move the market though, because the contraction was kind of as expected. It wasn't really, really dire. And a lot of it's already priced in when it comes to the commercial real estate side. Now, is there downward potential for those REITs and banks associated with commercial real estate loans? Yeah, I mean, if the company itself goes into bankruptcy, very problematic. But they should do what other people are doing and don't pay the costs, try to get better terms on the loans, or just default on select properties. No one's gonna hold that against you right now. Just try to survive. But unfortunately, the real estate sectors of the market maybe aren't ideal to be invested in. If you like calling bottoms, it's the bottom It's the most bottom of the bottoms at the moment, but there's still more room to the downside. So enough about real estate and things like that. We're looking at Tesla. Tesla's, it's consolidating. I hope this is the quote unquote accumulation phase of Tesla's price action. But what you want to see, like I said, I want to see a nice sharp move up. That sharp move up will do one of two things. It'll get people very long. People who, so when you hear the terms bull traps or bear traps, essentially it's essentially a quick move in price, right? And people feel like, okay, maybe the worst is over. I want to get long with everybody else. And then they got the quote unquote rug pulled, meaning the people who accumulated shares in this 256 area now have a nice little gain of 6.5%, right? And they sell, and the price just drops. Now, what concerns you is if you see the sharp move up, you need to look at how the price action settles as it sells off. Is it finding support at a price that makes sense? Meaning that, okay, we know there's a bunch of calls, right, at 270. If the price falls to 270 and kind of stays there by the close is important. The closing price is important. If it closes in that area around the 270, then you know that maybe, okay, look, they're defending the 270 for a reason. Someone owns those calls and they want those calls to go in the money, right? And as you see it being defended throughout the week, you start to understand who owns them. It's not you or me, most likely. It's people that have a lot more money than us put together. And they're the big time traders, the market makers themselves. So I want to see a sharp move up and a sell off. If we see a consolidation, not huge fans of that. It probably will bore us to death. But it sets us up for really high volatility in a very compressed end of the week. Friday alone could be very, very volatile, which might not be a bad thing, because if you are playing options on the close of Thursday, they're going to be quite cheap compared to going long right now. So that's the price action for today. I just want to take a look at some of the other sectors, and we can kind of maybe try to see how things are performing in relation to the S&P 500 benchmark. So we have the S&P 500 here. Let's just add a couple tickers and we can kind of understand. Firstly, we'll add Tesla. Let's compare IWM, which is the Russell 2000. These are the small cap market capitalization names. The QQQ, which will represent tech as well, like Tesla will, and the Dow, which had a great run over the past 14 days. And we'll just kind of move it so it's kind of around the beginning of July. Maybe not beginning of July. Let's do the middle of July and see how things are forming up for the market here. So from the 13th onward, Tesla, of course, had a really good run and sold off completely and has kind of underperformed the market. But you're seeing here is what I really want to show you is that how the S&P 500 is relatively flat compared to what? The Dow in purple is stronger than the S&P 500. It's moving up. The IWM had a very strong outperformance of the S&P 500. That's really good too. So, okay, if the Dow and if the IWM, which is the small caps, are outperforming the QQQ, which is the yellow line, it's outperformed, which is just basically following S&P 500, and of course Tesla. Remember, I said market breadth is a good thing, meaning if the market is coming back to an average of performance, meaning that, okay, tech had a good run. Okay, tech's up 150,000%. But what about my little bank stock? Or what about, my CVS stock or your Boeing? These names have been hurt very badly over the past 3-4 years. So seeing a little bit of outperformance could be a kind of like a little hint of the strength of the market, where we get caught up in following the Nasdaq, or we get caught up in following the S&P 500 because they're the biggest ones. But to have a real solid, I don't want to say bull market, let's say a secular bull market, meaning this is a long-term upwards trend with small pullbacks that are immediately bought up, and it just keeps going up. And basically what something looks like after the lows of COVID. It just goes up like 150%. The market's up from the beginning of this year. Like, what is it? Maybe the mid-20s? A secular bull market would be 5 times that. So small outperformance on the Dow, good. Recent outperformance on the IWM, good. Because IWM was tracking, the light blue was kind of tracking a little bit. It wasn't really doing anything special. We need to see the IWM move stronger than the S&P 500. And let's take a look. Let's move the dates back and see. So this is the beginning of summer, basically. And you're seeing this very slight divergence where the IWM is outperforming S&P 500 the entire time. It's outperforming the QQQ the entire time. It's easily outperforming the Dow. And you're seeing how the Dow is super depressed compared to the other tickers. And because we already know the Dow moves slow already, we know that the Dow has basically, quote unquote, accumulated for years and has broken out of this quote unquote accumulation. It had a very good last 2 weeks. Do you see similar outperformance over the course of the next couple of weeks? Very, very flat on the S&P 500. You can see here on the right-hand side, very flat. And you can see the Dow curling up. You can see even IWM outperforming the NASDAQ. Small caps outperforming tech. You want to see it. It sucks for your tech stocks, right? It sucks that, oh man, Microsoft is doing really bad. Meta is not doing so great. I wish Google can do better. Google needs to hit its all-time high. But the reality is these small cap names in the light blue, let me delete these white lines. They're kind of confusing. So that light blue line, okay, they're very sensitive to these rates that we're at right now, the 5.5% federal funds rate. They're very sensitive because small cap names, if they're only worth $1, $2, $10 billion, and Tesla's worth what, 850 or something billion dollars, sitting on $23 billion in cash, or Apple sitting on like $130 billion in cash, they're sitting on a lot of money. They don't care about rates other than the fact that it affects the ability of their customers to afford their products if they're very pricey. But small companies, they're not sitting on a lot of cash. They're sitting on basically lines of credit. They're sitting on loans from banks or from their venture capital backers. So cost of money is very expensive to them. So if you see any type of strength from the IWM, just know that that's good for Tesla. Maybe Tesla doesn't see the benefits immediately, but you're seeing companies that are on the brink of like bankruptcy, finding support in the market because maybe the market sees the end of the rate hike regime, and maybe a low interest rate regime starts at the end of this year and bails all these companies out. The market's always going to front run a move. They're always going to front run. So for example, if the market thinks the cuts of the interest rate are going to happen by December of this year, then they're going to be buying now. And the people who are buying December are too late. But let's say we get to December and there's no interest rate hike. Well, they sell it. And so that's why you see those violent moves sometimes when something doesn't materialize, is because these people have accumulating their positions for a very long time to front run a move. Okay, let's see what happens. Like if in December, the interest rates are actually cut for some particular reason that isn't a recession and the market goes up, you might see a very quick sell-off because they've been accumulating for like 7 months, 8 months, and they want to take profit finally. So I don't mind the look of this all that much. Look, by the way, this puts Tesla in perspective that, yeah, we had some pretty violent sell-offs, but the reality is we all know it wasn't but just a few months ago that this stock was at like $160 a share. It started the year at 103 or something like that. We're at $260 something a share now. So I know that sell-off sucked because it seemed unwarranted to people like you and me, but to the market, it did seem warranted that we didn't have enough clarity on margins. But just like the small cap names, automakers, they're very sensitive to the interest rates because their clients are sensitive, their customers are sensitive to interest rates. So if we can get car loans at lower interest rates soon, you're going to see Tesla do very, very well. But at the moment, what's happening is a record amount of people are paying for cars in cash. They're paying for homes in cash because they just had all this extra savings from COVID. So I hope that, by the time the savings run out for a lot of people, the wealthy, essentially, not like regular people, but the wealthy people, I would say some banks mention maybe this fall, like September-ish, where a lot of people's savings will be liquidated by then due to inflation, due to buying, what have you. So just expect that fall might be front run in the sense that people will take profit as we go into the fall, because the risk is that, the looming recession, quote unquote, that everyone seems to be talking about. But okay, I'm gonna stop dragging this on. I actually wanted to make this a really quick video. It did not become a quick video, but I appreciate you guys listening, and let's hope for a decent day. Remember, if it if it goes up quickly during the course of tomorrow, or even Wednesday to that 270 something, just be on the lookout for that. Okay, guys, take care.